And I'm going to let I'm going to let the four of you in on a little secret that actually nobody else outside of a few people actually knows. Is that you can buy the Kindle edition of the new book right now. It's $9.99 on Kindle. The paper, you can see I already bought it for myself. I bought it to look at it to make sure that it was it looks the right way. The first time we did this on Friday afternoon, downloaded the Kindle version, and the whole right side of the paper was cut off. And so had to go through a process, and the book designer had to load a different format file. It's not as easy as it sounds. I mean, it's not user-friendly and it's not simple. But anyway, the Kindle edition is available, the $9.99, the paperback. We're waiting for it to be approved by Amazon, and then we'll put it on the website. The paperback's going to be $30, and it's actually going to be in color too. So whatever you see, if you look inside the Kindle edition, the paperback's going to look the same. So anyway, just wanted to let you know, and if you happen to decide to buy it and read it, please write a review. But we're going to be making as soon as the paperback's ready, we'll be sending out more information. We're going to have a book launch event online on September 1st. And you'll be getting more information about that. Anyway, yeah, we spent about 3 hours Friday afternoon loading this stuff and going through what's called the Kindle Direct Publishing website and loading it. And and there's certain things you can do. Once you do them, there's certain things you can't undo. And then there are certain things you can change and stuff. So anyway, all righty. So let us get started. Today we're going to be putting things together. We're going to talk about analysis and decision making. The first part is going to be, we're going to look at costs and understand the relationships between sort of lean operating practices and costs. And then we're going to go into some more complex, well, they're not, I mean, we're going to look more at like box score decision making. And I have 3 case studies which are in the Excel file that we're going to do. We'll sort of I'll let you guys do them, and then we'll get together and discuss. If we have time, I do have a little wrap-up presentation on doing a lean accounting transformation if we have time to do that. And also remember that included in all this is sort of like another 1-hour follow-up that is free, that sort of you can use it at any time you want. There's no time limit, but if in the near future you want to talk specifically about your company, we can talk about it. And if it's 3, 4, 5 months later, we can still talk about it. All righty. All right. So what's interesting about lean thinking is there is a lot of focus on costs, and Taiichi Ohno who sort of was probably like the creator of the Toyota production system, even though they just sort of did stuff. It wasn't like they intentionally said, we're going to create a production system. They did a whole lot of things and it made a whole lot of sense. And it wasn't till, probably like in the 70s that they realized they created something important. They don't call it lean in Toyota, by the way. It's the Toyota production system or the Toyota operating system. Anyway, there's lots of Taiichi Ono quotes. You can Google them. And I always get a kick out of this one because, it's very clear how they think about costs. It's about, they need to be reduced. And when it comes to lean thinking and lean accounting, it's really about how costs are reduced, sort of the methodology that's used, and also how they're measured. And it's, some of you may already have some of these practices in place. I don't know, but a lot of companies don't. It still sort of amazes me when I talk to companies how they sort of still have the sort of traditional top-down approach to managing costs, which is pretty much trying to control and cut costs through things like budgets and sort of management initiatives or edicts about doing things. So how does lean achieve cost reduction? One is there are actual cost savings. Okay, and what we mean by this is the expenses go down and you can see it, sort of like you can see it immediately. Then there's cost avoidance, which are actions that are taken to avoid incurring costs in the future. And a lot of this has to do with continuous improvement. We talked about the economics of lean, and it's the relationship between capacity and costs. And so, it's really important to be able to distinguish between the two. I've seen companies that, what they try to do is monetize cost savings or monetize time savings. We've worked in over the years, worked in more than one company where sort of from corporate or from the executive team, it's like all improvements need to show a cost savings. And the lean operating people, they sort of get all tangled up in that because intuitively they know that they're not actually saving costs, but they have to show something. And, whenever you tell anyone sort of in upper management that we are saving money, they expect to see it on the financial statements. I worked in one company, went in there, they actually had been doing lean for a few years, and they had a lean consultant in place, and they said that, over the past X number of years, they've saved, it was like, 15 million in costs. And this wasn't a large company. And I said, oh, really? How do you know? And all that. And they took me in this room and they had a lot of charts on the wall. It was like an obey room. And they said every week the managers get together and they talk about the improvements that were made and they sort of calculate how much they've saved. And a lot of it was things like, well, we saved this much time in accounts payable. And so they monetized the time savings. So very nicely, I just said, well, have your expenses gone down by 15 million since, however long ago? And they said, no, so it's just things like that. All right. So this is a sort of participatory chat that we want to have. And so I want you to understand the relationships between capacity and cost when it comes to labor. So for example, full-time employees, what type of capacity is it? Permanent or temporary?
Permanent.
Permanent. So what type of cost would it be, fixed or variable?
Fixed.
Yeah. Overtime. What type of capacity?
Variable.
Temporary.
Temporary, variable, yeah. And what type of cost?
Variable.
Yes. And this one's a little obvious, temporary employees.
Temporary
Yeah.
and
Variable.
variable.
How about if you have contract labor?
That's temporary as well.
Temporary.
Yeah, see, does this make sense?
Mhm.
But like in a lot of companies, how, especially manufacturing, how do they view the labor in operations?
Direct.
Yeah, they call it direct, but okay, because it's direct, how do they think about it? Or how does a costing system show it?
It thinks of it as variable.
Yes, it thinks that that's right.
Yeah.
It thinks of it as variable. So people think direct labor is a variable cost. Because if we change the run rates on a particular product, that's going to change the direct labor cost and go up or down. And by the way, sort of the nasty part about product costing systems is you change the run rate, you change the direct labor dollars, and you typically also, the overhead dollars change because they're calculated off the direct labor dollars. So that it creates the illusion that the cost is variable. And so, people start thinking, how can we take direct labor time out of a product? And to tell you the truth, any direct labor time to produce a product is pretty much fixed based on the product design. You can't just sort of willy-nilly say, make this thing faster. So again, this is a big shift in thinking, that your full-time permanent employees are a fixed cost. And that, the benefits of improvement come from being able to, if you create capacity, you can reduce the variable, reduce overtime, reduce your temporaries, and use that, that's an actual cost reduction. So how about, let's look at machines, okay? Because people or machines are usually the two resources that do the work. So depreciation and tooling, what type of capacity would it be?
Permanent.
And that means it would be what kind of cost?
Fixed.
Yeah. So, you think about overtime. Now, if you're running a machine overtime, you're not paying the machine anything, but you're paying employees. So that means what? That's more that, you need the operator there. So, the machine, you're using the machine capacity, it really doesn't change the cost that much, but you're paying operators more money to work overtime. If you think about downtime and, machine has to be fixed, there's no real capacity impact there, except, you don't have the capacity. But what type of cost? If you improve downtime, you should be able to what? Reduce some of those costs. You can also make a case For downtime, if you have internal maintenance, the less downtime you have, the more capacity you have in the maintenance department. And in some cases, some companies outsource because they need some capacity. So that would be what?
That would be temporary and variable.
Yeah. Yeah. So again, it's important to understand these relationships. It's important to incorporate these relationships in analysis and decision making. And again, a lot of people, and going back sort of to that product cost discussion we had a few minutes ago, thinking patterns have been established by using certain numbers. And it's sometimes a little tough to break those habits. Okay. And so you sort of have to focus, that people have to learn the new relationships and sort of become comfortable with them. And there's lots of ways to prove it, show it, which we'll do a little bit of that later on today. All right, so labor costs. So think about making improvements. And this is a brainstorming exercise, a brainstorming discussion, not exercise. So what would be some ways that you make through continuous improvement that you show actual savings in labor costs? So you've made some improvements, you have capacity, you apply that capacity, and you use that available capacity. So what are some ways that you could use that available capacity and have an impact on costs?
Reduce the employee turnover.
Okay, yeah. And so less turnover, but if there is turnover, what can you do? Like an employee leaves.
You could cross train.
Yeah, you can do some cross training. But no, employees leave for a variety of reasons. But if a full-time person leaves and you have available capacity, and let's just say, one full-time employee leaves that works in a value stream, what are some decisions you can make that can impact cost?
Are talking like standard work.
Well, how about not replacing that employee? Right? We have available capacity. We just don't have to replace them. So, that salary goes off the books, and that we see that immediately. So what are some other ways to maybe reduce that cost instead of hiring another person?
Increase throughput.
Yeah, that would have if you increase throughput, is that going to have a cost impact or a different financial impact? I'm just looking at the cost side. So you can promote internally and backfill. Okay, so if a value stream manager were to leave, you could have an internal replacement, for value stream manager, and you can backfill in a lower paid position. That's going to lower cost. As we said earlier, you can also reduce the temporary capacity. How about if you outsourced labor operations? What could you do?
You could bring that work back in.
Yeah, you can bring that work back in. In fact, just reminds me, I was actually working with a company outside of St. Louis. And we were doing a lean accounting pilot, and we calculated capacity, and it became quite apparent that there was a lot of available capacity. And it was really just sort of interesting that this was a smaller family-owned business, and the owner of the company looked at the team and said, "What about those parts we outsourced to China a couple of years ago?" Because the cost of outsourcing it was lower than the standard cost. They said we could start, we don't have a contract, or much of a contract, so we could bring those parts back in-house immediately. And we did a quick sort of back of the envelope calculation, and and they were able to save like $45,000 a year just by doing that, because they had outsourced based on the standard cost. What are some ways to avoid costs? And Steve, you mentioned something like cross-training, where you can have flexibility in moving people around. What would be some other ways, maybe? How about direct redeployment, meaning, value stream A, we have available capacity, but in value stream B, we don't. We could take some of that labor capacity from value stream A and move it to value stream B. And, the labor cost stays the same, but it's not going up. We don't have to hire somebody in B. You mentioned the cross training. Here's David coming in. It's always good to have more generalists than specialists, because you can move them around. I did work here in Lexington at a software company, and in their customer service, where you call up, you submit a ticket, you have a software issue. They had about 6 or 7 people in customer service, but they all had specializations. Nick knew this part of the software better, and that's all. He just worked on those tickets. And Helen knew this part of the software, and she worked on those tickets. So what would happen? What do you think would happen with all this specialization? Well, what would happen is Nick would have a whole lot of tickets on his part of the software, and he was overworked, or he had a big backlog. But Helen didn't have she didn't have tickets, but she didn't know that piece of the software as well. So you had this imbalance. And so what they did is they started sort of cross training, where you had, obviously there were people that had specialties, but you were trying to have people with more than one specialty. And if you have other available capacity, you can always assign people to improvement activities or other temporary assignments. Now, this is not in, these things are possible when you're not in sort of like what we went through last year, an economic crisis, or what we went through in 2008, where there's just a severe economic issue. And, for survival purposes, you might have to reduce headcount. I mean, that's a different issue. But, in a normal course of business, you have available capacity, and you need to do things with it. And I always say that from this is where you always talk about what's the role of human resources in a lean company. And it's really, really important to have a plan for this available labor capacity. What are you going to do with it? Make the assumption, that we're going to create 10 to 20% capacity a year through improvement. What are we going to do with, you got to have a plan. Whether in operations, you can always say, well, we're going to sell more. Okay, we get that. If you're thinking about administrative functions, you really have to talk to the people, because they're going to figure out, if I'm in accounting and we improve the quality of accounts payable, I have less work to do. What am I going to do? They're going to figure that out really fast. So have a plan. Okay. And, it's always important also to talk about this up front. So when I was CFO at Bullard and we hired the vice president of manufacturing, one of the first things he did is he talked to the owner and actually to the whole management team. And he told the owner, he says, I need you to verbally make a statement to the company and also put it on a piece of paper on the bulletin boards that nobody loses their job because of continuous improvement. Now, the caveat would be economic conditions are a different issue, and at first the owner didn't want to do it. He said, I'm not going to do that. But the vice president of manufacturing persisted and said, no, I need that because people can't be afraid to improve and that it's going to impact their job. So if you haven't had that discussion inside your company, it's important to have it and make sure it's very clear. Any questions, comments about this? About machine costs, okay? What would be some ways that if you make improvements in machines, you can realize some actual cost savings? And just sort of as you're thinking about this, when you're trying to make improvements around machines, it's pretty much making the machine available. Okay, and you don't want to overproduce or anything like that, but you want to sort of all the different, reasons that the machine could not be available to produce good parts. So what would be some actual savings?
Maintenance and repair cost.
Yeah, yes, maintenance and repair costs.
You could take a look at how you nest your parts.
Yeah. Mm-hmm. There's also reducing overtime if that exists. Talked about replacement parts. Outside maintenance costs, which that's part of the maintenance. Talked about outsourcing, okay, earlier. I mean, I worked at a company in 2019, and they regularly outsourced to local machine shops various machining operations because they didn't have the capacity, or they didn't think they had the capacity. Then there's also, you could also right size machines, meaning if you have a large machine that has lots of available capacity, you can consider maybe buying smaller machines. And that would reduce, you'd have probably less depreciation and things like that. There's also avoidance, again, if you make improvements, you don't have to hire more operators or more maintenance people, and you can avoid buying new machines. At at um, at Bullard, we had somewhere, I forgot, 10 to 12 injection molding machines that stamped out things like hard hats and suspension parts and things like that. And in our conventional manufacturing days, we never had, we were working multiple shifts and overtime and weekends, and we just never had enough capacity. And in the slow season, which was the winter, we built inventory because we couldn't meet it um, in the busy season, which was spring and summer and fall. And we hire people with lean thinking experience, and we soon find out that we have a whole lot of problems with changeover times. There was also changeover times, a lot of scrap. And again, it was like tribal knowledge where people thought, not without evidence, that certain tools only worked well on certain machines. And so you had certain machines that were running multiple shifts, and then you had other machines that were sitting there only working one shift. And what was interesting is that over the course of about 3 years, all of those myths were broken. Changeover time, which took hours, was reduced to like 30 minutes, and scrap was reduced. And they realized that the tools could be the actual tools could be used in multiple machines. And what we end up with is more capacity. All right, we had like 10 to 12 machines, and we had excess capacity. What we ended up doing, we thought about selling machines, but again, we were worried. It's not like buying a machine takes some time. And so we actually became a contract manufacturer for one of our competitors, because we actually manufactured some of their hard hats. So we were able to use those machines and make some money off it. So
I was going to bring that up myself. We have done that in the past as well.
Yeah,
Became a contract manufacturer for other groups.
Yeah, it's and it was just a very interesting discussion. And it's just sort of amazing how the thought in the period of about 3 years, the thought, it's sort of the view of capacity just totally changed. We didn't have enough, we had too much. And so when it comes to lean practices and your resources, the people or the machines or the equipment that do the work, you're making improving productivity. The primary outcome is capacity or time. And when you want to, when it comes to costs, and you want to be accurate, if you apply capacity to value-added activities, what's the financial impact? Is it costs? It's more revenue and sales, right? But if you redeploy that capacity, then you can have an impact on costs. So, it's understand those cause-effect relationships. And if you think about it, value-added activities, you can reduce temporary capacity, or you can redeploy or reduce your permanent capacity. And that determines what your financial impact is. And it requires some new ways to think. Using box scores helps. Having a measure of capacity helps. People understand this. It's just, and this is one of the reasons why when it comes to using product costs for analytical purposes, it can really drive sort of different types of thinking and even different types of decisions. We have many horror stories of companies that made very poor decisions using standard costing. But that would take up too much time to tell you all the stories. Any questions about the, labor costs, machine costs, and capacity and cost management? Any thoughts around the way your company thinks about it? You guys are quiet this morning. All right. Let's talk about materials. So, in manufacturing, it's materials. If companies are not in manufacturing, sometimes they have lots of supplies now, and sometimes it's even considered inventory. Sometimes it's an expense. For example, healthcare has a lot of supplies. Okay. In some businesses, the material cost is not significant. So what are the 3 ways to manage material cost? Or really, let's not 3 ways, but what can you focus on? And I'm not getting specific. I'm just think about what's the equation to calc for a material cost? What's the equation? What's the general equation? Price times quantity, right? Whether you're looking at the price of one part or how much material do you have? It's price times quantity, right? So what are the ways? So how can you focus efforts on that equation?
Reducing the scrap.
Okay, yeah, you can focus on reducing scrap, which reduces the quantity.
Negotiate lower prices.
You can try to get a lower price, that's correct. Any other ways to focus on the quantity?
You could redesign the product.
Yeah, you can redesign the product. I'm thinking more along the lines of inventory. Less inventory, right?
Less inventory, yeah.
Yeah.
One piece flow.
Yeah. So again, it's you have to look at both sides of that equation, because traditionally, what's the traditional way to try to manage material costs out of these, what's the traditional way? Conventional way.
The price of a part.
Yeah, you beat up your suppliers, right? Or you try to, you're just shopping for the lowest price possible. And that doesn't always work, because you may get a lower price, but that may come with what kind of unintended consequences.
get
focus just.
poor service.
You could get poor service, yeah. What else?
Could be short-lived.
Could be short-lived, right? But also, for example, if I'm a supplier and one of you came to me and said, hey, can you give me a price, get my price break on this? I might say to you, sure, I can, if what?
If you buy a ton of it.
Yeah, if you buy a lot of it. So, it's, lean companies, price is a function of value. So what does a lean company value from their suppliers?
Service.
Yeah, service. They want, high on time delivery, good quality, short lead times, and they want it at the lowest price possible. But they're not just gonna, because if you don't have high on time delivery, if you don't have short lead times, and if you don't have good quality, that just sort of impacts operations. And so it's price is a function of value. So if you're looking at changing the purchase, if you're trying to reduce the purchase price of a part, there's 3 ways to do it. What would they be?
You could shop around.
Yeah, you could change the supplier.
Try to substitute a different part.
You could try a different part. Or
The supplier.
you could talk to your supplier about a lower price. But again, actions have to be taken. And when it comes to, if you're buying a supply that's not used in making a product, you have more flexibility. You can buy different types of supplies, maybe. But if you're talking about parts that go into products, and I think Steve, you mentioned this, it really has to be an engineering change. You can't just substitute a part because it could change the quality or the ability of the product to perform properly. So, if you are able to lower the price of a part, and let's just use one, the calculation is easy. Okay, how much is the price reduction? What's the annual usage? That's how much we're going to save. Now, what's unique about materials, and let me ask you this, will that cost savings be visible in the financial statements?
Not necessarily.
Yeah, and why do you say that?
Because the price of other parts could go up for one.
Yeah.
But
Yeah.
Hopefully you'll increase your turns, so your
Right.
cash flow would get better.
Yeah. So you could calculate the annual savings, but it might be hard to see. And that's what makes it difficult, because I was working with a company that I work with periodically, and I was working with them pre-pandemic, and they had a strategic initiative to lower material cost by 5%. And I said, well, how are you going to know? And nobody had really thought it through, because they were thinking, well, the material cost on our financial statements will be 5% less than what it was the prior year. And I sort of had to explain to them what we're talking about here, that, it's not that simple of a way to measure it, And so anyway, so, scrap, we talked about scrap. So here's a little exercise here. So you might want to turn on the calculator on your phone. So let's say that, the annual scrap cost in the financials is 50,000. The first time through rate, not the scrap rate, the first time through rate is 70%. And let's say some improvements are made where the first time through rate increases to 80%. So what's the savings? What's the annual savings by improving quality?
$5,000.
Okay. Anybody else have any ideas?
7,150.
Okay. Yeah. 7,150. Okay. Because the increase in the first time through rate from, there was a 10% increase. So that's, I'm sorry, the first time through rate went from 70% to 80%. That's a 14.3% increase in that rate. So we're going to save 14.3% of 50,000. So again, it's just, I'm just giving you some simple ways to model all this. Days of inventory also. So again, the point is, the point with this is, you want to, in order to improve or in order to reduce scrap, focus operational efforts on the performance measurement. So if you're using first time through rate, what do we have to do to improve it? If you're using a scrap rate, what do we have to do to, reduce it? And as a result of those actions, you will achieve cost savings. So it's cause and effect, okay? You don't want to start with the cost and say, oh, scrap needs to go down by, 25%. Okay, when you're looking at scrap, you need to look at a scrap rate or a first time through rate, because that's where you're going to get the root cause by measuring that frequently. If you're looking at the dollars of scrap, it's not going to necessarily tell you the root causes. Same thing with inventories, the same. So let's say we have $1 million in inventory and we have 60 days of inventory. So we make improvements, or we're going to make improvements. We're going to get it down to 45 days. What's the savings? This one's easy.
250,000.
Yeah, pretty simple. But again, will you necessarily see that in total?
More in your cash flow than you would your income statement.
Yeah, you'll see it in cash.
Yeah.
And again, you could have 45 days of inventory, but if it's the value may not be, 750,000, it might be 850,000 because you have more inventory, but it's still flowing faster. So it's not, and again, this is where a lot of people get hung up just looking at the value of inventory on the balance sheet. This is, and we got to bring that down. But again, it's about velocity, and it's about the flow of material through through a business, and focus on the turns or focus on the days. And, you know, everything, and as long as the days are going down, everything's great. Yes, eventually you will see the dollar value go down, but it may not happen as fast as you think. So, you know, those are just some ideas about cost management. And it's really, really important to bring sort of this new thinking into the organization about how costs behave. And, you know, if you're in finance and accounting, this is really a leadership opportunity. And to sort of, and you really have you may have to do a lot of coaching to get people to start thinking differently. But, you know, introducing the new information, introducing new analytical practices, talking about capacity really helps this out a lot. The other piece which helps out a lot is how you measure it. Measuring cost reduction. So think of it, you know, there's 3 levels of measurement that we talked about, you know, monthly or company level, weekly or value stream level, daily or cell level. So, you know, what's the best, what are the relevant measures that will help people understand cost reduction? And the other thing is, with lean thinking is, you know, it's cost reduction over time. It's not short term. So the best, you know, a good measure to use at a company level is, you know, an actual cost as a percentage of sales. So what's our, you know, full-time labor cost as a percentage of sales? What's our gross margin as a percentage of sales? Actual gross margin, okay? Or any other specific line item. And you know that those company costs are not going to move significantly in the short term, and people need to understand that. At a value stream level or a weekly level, you can again use actual costs as a percentage of sales. You could also use an average cost per unit. This would be actual costs of the value stream divided by like units shipped or units produced. And again, you know, they don't, these numbers don't move quickly, and it's counter to short-term thinking because everybody, you know, it's about make the month and stuff like that. If you're at a daily level, it's very difficult to get costs at a daily level, at a cell level. So what you want to do is you want to look at what's driving the costs. So for example, overtime. Okay, what are the overtime hours? You know, we don't have to monetize it. We just need to know how many, you know, why did we work overtime yesterday? What were the reasons? And then you can begin to understand what can be done to reduce the overtime. So you look at sort of the drivers of costs at a daily level. Because, you know, if you think about a cell, you know, managers don't have a whole lot of control over costs, especially when it comes to like people and machines. Now, scrap is a different issue. So, you know, have good measures of costs, and make sure people understand, like when we were especially talking about labor, you know, if you want labor cost as a percentage of sales to go down over time, Are we making improvements? Are we creating capacity? What are we doing with that? Any questions about the measurement side? How do your companies view costs right now?
Primarily at a monthly level.
Yeah,
Although we're starting to go down the weekly path, but it's still in its infancy.
yeah. Okay. Yeah, that company, the company that I talked about a few minutes ago that wanted to reduce the material cost by 5%. They also, the senior team was also concerned about overtime, that there was a whole lot of overtime in operations. And so, you know, they did the traditional overtime analysis from accounting just by hours, like on a weekly basis. You know, this department had this many overtime hours, and sent it to sent it to the leaders. The leaders then asked the operational managers, well, why did you work overtime? And nothing ever got solved. And so what I suggested, they had daily huddles in operations. And I said, well, just start talking about like I said a minute ago, just talk about overtime in the daily huddles. Why did you work overtime? What were the reasons? Just get the reasons, you know, and start, you know, gathering data on the reasons, and then figuring out in each certain cell, what can we do to eliminate those causes? And then over time will go down. And it was a shift in thinking, and it required accounting to also go to daily huddles on a daily basis, which was something new for that accounting team. All right. Let's just take a quick 5-minute break, and then we'll do the decision making, okay? Let me know when you're all back. We'll get started. Everybody ready to go?
Yep.
I'm just looking. Just want to get a verbal from Helen, Sandra, and David.
I'm back. I'm back.
All
Sandra.
right. All right, good.
David here. David is here. Thank you.
Okay, good. Okay, so let's put this all together, put this whole lean accounting thing together, talk about box score decision making. Okay. Got a little bit of a overview of the principles of lean decision making. Then I really want to spend most of the time on the exercises that are in the Excel file. So if you haven't opened it, you may want to open it, and we're going to work on them sort of as a group, where I'll give you a few minutes to play with them, then we'll come back and talk about them. All right, I mentioned this since last Monday. It's really, really important, and I think it's one of the keys to unlock success with lean accounting. I always tell companies it's easy to create a box score, it's easy to create a value stream income statement, but getting people to use them in a consistent manner in terms of analysis and decision making, that's the hard part. Because in some cases, value stream income statements, lean performance measures, and especially capacity, these are new numbers. And people have been using different numbers. So it's almost like they have to, there's this, this idea of, they have to unlearn certain things and learn new things with new numbers, new patterns of thinking. Because you want to avoid the disconnect between the numbers not being aligned with lean thinking practices, principles, and tools. And if the numbers are aligned with lean thinking, then in general, you're going to drive the right behavior and drive the right types of decisions. And this learning cycle is sort of self-reinforcing, meaning, okay, we use the numbers, we make a decision, or we operate in a certain way, we see the results, it's good, and so it reinforces using the numbers. So again, there's some different patterns of thinking which we need to focus on. One is, again, we've been talking about this a lot, about what the impact of improvement is and how improvement creates capacity, and the application or the use of that capacity really drives sustainable financial success. Another aspect is these relationships. Okay, the relationships between operating performance and financial performance are not linear and static and direct. They're very, very dynamic. Okay, and again, traditionally, it's really just operating performance and costs. But when you throw capacity in there, that sort of creates a new dynamic. So whether you're looking at, how do we want to, I'm sorry, mixed up here. We want to establish the true cause-effect relationships between operating performance and financial performance. Whether we're doing it from the bottom up, for example, if operations performs this way, what's the financial impact? Or vice versa, if we need improved financial performance, what has to change operationally? We want to avoid that sort of conventional, what I call financial engineering, where you just dictate what has to be done. We need to, we need to reduce our cost by 5%. And managers just sort of say, okay, and they try to figure out how to do it. You might get some success, but in the long run, these costs seem to come back. I know, Steve, you mentioned you're starting budget cycles. I meant to mention this when we were doing the cost management. Actual to budget as a performance measure is not really, really good. Okay. Now, yes, you have budgets serve a purpose. Okay. And most companies want to have some kind of financial budget based on certain assumptions. But when you drive it down into low levels of the organization and when managers are either directly or indirectly evaluated on that, it can cause a lot of, well, it could cause dysfunctional behavior, but it really confuses people, because what's the problem with budgets?
They're static
They're static, that's right.
and things change.
Yes.
Priorities change.
Yeah, things change.
Somebody asked for 1 or 2 additional employees during the budget cycle, but then priorities change.
Yeah.
They question whether or not they get them anymore.
Yeah, a budget is made on a bunch of assumptions, and when you're budgeting when you're budgeting for a year, nobody's good at. That's why budgets get padded, because people are afraid that if managers have to set budgets, they intuitively pad it because they know that they can't predict, and they just don't want to sort of get their finger pointed at them that your actual is greater than your budget. And it's one of those things which every company does it. Nobody likes it, but they keep doing it. It's just,
Well, until somebody comes up with a better methodology for paying bonuses.
well, yeah, that's right.
That's
Yeah.
usually the hang up
Yeah.
is that, you under promise and over deliver, and that's how you get paid.
Yeah.
And
Right. And that's where, the companies have to have serious discussions. The best if you want to tie anything to any kind of performance bonus, performance measurements, lean performance measurements. Okay. And so, if you have value stream performance measurements, that everybody on that value stream team, if they move those measures in the right direction, that impacts how much they get. We did that at Bullard. Life became simpler. And, and also it really motivated people. I remember people just sort of operators from the shop floor coming in to ask me some questions about their performance measurements, and because they wanted to know how they worked, because they they knew that if they move them in the right direction, they get a bonus. And it just changed the whole thinking. So anyway, that's just I don't want to talk too much about budgets because,
One thing that we've done that is kind of bridge that gap, is that we pay a bonus quarterly on 10% of whatever our operating income is.
yeah, that's
And
good.
that way, you're not really comparing to budget or even year over year,
Yeah.
so in a downturn, you can still potentially get a bonus, but
Yeah.
it, like you said, it motivates people to do the right thing.
Yeah. And this one company I'm working with, I'm going to work with them tomorrow and Thursday, and we've been working. We have 7 sessions, and we had a session. They had to take a week and a half off because, and this is a larger company. It's actually international. One reason the accounting team had to take a week and a half off from doing this work is they were beginning their budget, and they do budgeting and they also do forecasting. So they have the static budget, but then they do a forecast. And they also had to roll their standards. Anyway, sorry, I got off on a tangent. When you think about the users, the internal people who either have to make decisions or do analysis and make decisions, they need understandable and useful information. Okay, and lean thinking changes the definition of what's understandable and useful. And it's important for accounting and finance as sort of caretakers or stewards of a management accounting system to understand that the management accounting system needs to adapt to a lean strategy. So if you're in a lean organization, what's understandable information to most users? It's based on economics of lean, stuff we've been talking about for a week now. What's useful for a specific decision is the relevant and reliable information for that decision. And you can see, predicted value or feedback value, it's useful. Timeliness, the information needs to be there when a decision needs to be made, and it needs to be based in reality. So there's lots of sort of aspects of value that need to be understood by accounting and finance. And, this is what drives good decision making. Also, standardized work. Now, in lean thinking, standardized work is the best known repeatable process to perform a task. Now, standardized work for business decisions, it might seem like it might sound a little strange. Oh, well, we know how to make decisions. We've made these decisions for a long time. Well, let me just mention, have you ever been in a meeting where some type of analysis and or decision has to be made, and like corners are cut, or the rank in the room, the person of a high rank that's in the room just says, oh, this is what we need to do. Have you ever experienced stuff like that? Without like going through a route, an objective process.
Yes.
Yeah. And so again, this is, we we want to avoid that. And, these are just 5 simple steps. What's the, why are we doing this analysis? What is the information we need? And we don't want that information just people sort of verbally blurting it out. Make it visual. Put it on a whiteboard. Put it on, call up an Excel file, put it up there. What do we hope to get out of this decision? What's the economic value? I'm going to talk about economic value here in a second. Next slide. Then what's the action plan to make the decision? And then how do we compare actual to what we assumed was going to happen? And here are the 6 possible outcomes of any decision. Okay, increase in demand and change in demand or change in sales. You can change fixed costs. You can change variable costs and margin. You can change capacity, impact on performance, impact on cash. And this is where the box score comes into play. And when you have a box score in place, and if you analyze decisions through a box score, you sort of by default have to consider all this. I'm not saying that every decision, all these are impacted, but you got to ask the questions, or you got to think it through. And the other thing to avoid cutting corners is, what's the current state? What is the incremental change? The complete incremental change. And then what's the future state look like? And is the future state better than the current state? And again, you got to calculate that total incremental change. And it's the incremental change over the time frame of the decision. So sort of the longer the scope of the decision, the more you have to consider. But if it's a short-term, one-time decision, there's less to consider. And again, you got to avoid sort of the cutting corners. You got to avoid we've done this before, we know how to do this, and all those other things which go on in making decisions. So that's sort of, you want to examine the decision-making process. The other part of decision-making in companies, especially when it comes to like this, is what I call functional decision-making, where you have, for example, I'm going to pick on sales because we don't have any salespeople here. You have, sales, they want to, they're trying to get orders or get business, and they make commitments to customers without considering sort of the impact on operations and capacity. So I'm not saying that, but they're not considering the costs. They just want to get the sale, things like that. So there's lots of functional type of decisions that are made. And again, this is a role that accounting and finance can play, and sort of, I call it sort of, it's not being really the referee, but it's sort of like being a coach. And you're sort of the head coach of analysis and decision making. You don't, and you want to make sure that there's consistency across the company and how, in the data that is being used and how it's being considered, and are decisions made in the best interest of the company in total. All right, any questions, comments? All right, so it's exercise time. So open up the Excel file, okay? And what I'm going to do is I'm going to give you the background. I'm going to tell you what to do. It's going to be on the screen. I'll give you a little bit of time to do what you do in the Excel file. Then we'll discuss. I'll show you what I've done. And in a lot of these exercises, there's not one answer. Okay, there's some thinking involved, some assumptions that have been made, and that's why I really want all of you to sort of do it on your own, and then we'll discuss as a group, because it's always interesting, even for me, to see how people approach these. All right, so open up exercise 1, which is continuous improvement. All right, so you're an operational person, or you're part of a value stream team. And you see the current state capacity is 6.56%, right? Everybody see that? So your objective is to think about some improvements that can be made, because operations wants 20% available capacity. So go to the future state box score column and start, you focus on, you're not worried about changing how many units are sold or cycle times. You're really focused on the non-productive activities and what type of improvements can be made in any of those to get to 20% capacity. So I'll give you, it's 5 minutes before the hour. I'll give you 5 minutes to do that, then we'll come back, okay? I'm going to keep my voice on if any of you have any, and video on if you have any questions. All righty. So, who wants to explain what they did?
I can't.
Go ahead, Steve.
I improved the inspection time from 10 minutes down to 6.5 minutes. I improved the downtime from 20% of the time to 12% of the time. And I took the 5S huddle down from 15 minutes to 10.
Okay. How about you, Helen?
Well, I did the same thing with the huddle and the 5S as well. But I also reduced the scrap percentage. See if they can't work on scrap and rework and get that from 20 to 10.
Okay. Yeah. Sandra, David, what did you come up with? You guys there? Sandra? David?
Oh, I was on mute. Now I'm available. I just focus on the people or machines, on the opportunity to
Yeah.
start with, and I just change it to 4. And the bottom line goes to the 19, almost 20, so you can contract additional 4 to 5 people.
Okay. All right. Yeah, I'll just, yeah, and here's the point is, you know, you can look at this when it comes to improvement, you can look at it both ways, meaning, okay, we are doing an improvement event or maybe a series of events. What do we expect to achieve? And you can show that. Or you can do this like the exercise. We need this much capacity. You have to figure out some improvements. I just did 2 simple things. I reduced the scrap rate from 20% to 10%. So, you know, we reduced that and we reduced downtime, and, you know, that created plenty of capacity. And there's lots of different options. That's what's important to understand. And, you know, from a lean viewpoint, continuous improvement is not random or haphazard. It is thought through, it's disciplined, it's planned, and there's a purpose for it. And so again, when you focus people on quantifying the improvements, then that starts driving discipline, and they have to think about, because there's lots of opportunities to improve, and it's sort of like return on effort. You know, what's the highest impact of having time? You know, if we focus so much time on improvement, what's the best impact that we get out of that? And and you can use numbers to do that. Okay, so that's number 1. That's the first. So now we're going to get a little more involved here. So we're looking at a one-time customer order. So a customer would like to buy 500 units of the product that the value stream produces at a special price of $30 per unit. It's a one-time order. Now, the regular price, if you scroll down, is $35 a unit. So, you know, customers, give me a special price. So enter in the opportunity column, enter 500 units in rows 11 and 13. And then in the opportunity column, enter 30 in row 60. And then take a look at the future state column And you have to decide, would you accept this order? Yes or no? And what would be your reasons? Or what has to happen in order for you to accept this order? So again, give you 5 minutes. All righty. So who would, I'll show you my screen. And so I'll tell you what I did, so we put the 500 units in and what we see is, okay, we only have 0.48% capacity. So what were some of the things that you guys did? Or what were your decisions? Would you accept the order as is?
Well, it's one time, it could be accepted.
Yeah,
I just have one issue with the price. Because the current price, current state price is at 35, and we're accepting just a one-shot deal, giving it to at 30. I
Yeah.
would deal with the price of the items that are being selling.
right, yeah, good, very good point, right. Yeah. Because you always have to be concerned if you give this customer $30, you know, what happens if everybody else finds out? But, you know, that's in, a lot of times this is, you know, customers are always trying to negotiate this. So you see that, you know, financially you make more money, even at $30, you make more money. The question really boils down to the capacity.
Yeah, I didn't, I didn't make any changes, because we had the excess capacity.
Yeah, you had 6.5%.
We had 6.5%, and that pretty much filled it. So we were making the 6,800 in contribution margin on it, so.
Yes.
Yeah. Yeah. And a lot of times, you know, anybody else want to share their analysis? You know, what I did, you know, I said, okay, let's work overtime. Okay. Because, you know, we don't want to go, from an operating standpoint, lean, sort of lean operations, they never want to use all their available capacity because you never know when things go wrong. You know, the real question is what we don't know is how long will it take to make these 500 units, you know? So maybe we could just make it by working a little bit of overtime rather than doing it in the regular shift. But again, you know, it's not, this isn't just a clear cut, easy decision because you have the capacity to take into account and then you have the prices to take into account. All right, so now we're going to get, now we're going to look at exercise 3, okay? So it's similar to exercise 2, but we have a future increase in demand expected. So sales expects monthly demand to increase to 1,500 units a month beginning in the next quarter. So in the opportunity column, enter the 1,500 units in rows 11 and 13. Now we're putting another condition on this. So is there enough capacity to meet this increase in demand and maintain that approximately 7% capacity? I think it's 6.56%. Okay, so just round it up to 7. Okay, so is there enough capacity? Yes or no? That's the first thing you have to understand, answer to yourself. And if there isn't enough capacity, then what are you going to do? Because the demand is coming and you have to maintain 7% capacity. So I'll let you go at it here. For a few minutes. Enter the information in the opportunity column, then look at the future state column, make all your changes in the future state column. You can't change the cycle time. Anybody need any more time?
Yes, hold on a
Okay.
second.
Okay.
Okay, I'm ready.
Everybody else ready? All right, so David, what did you do?
We're from bottom to the top. I ended with an 8.14%.
Okay,
The future state. From the bottom to the top, I just made some changes on the downtime percentage to 15%.
okay,
The scrap and rework, I updated to a 15%.
all right,
And then I got up the overtime hours to 1.5.
okay.
That makes me end up with a available capacity of 8.14%.
And you're still making more money, right?
Yes, correct.
Good. That's, anybody else?
I just took scrap and reworked to 10 and downtime to 10. And it came up with 6.94.
Now, the only other thing I thought about is if they didn't want to move scrap or downtime, look at the possibility of going to a second shift
Yeah,
to accommodate the increase of, I didn't change it on the sheet, but it just something that came into my head of, maybe you do a second shift or a split shift.
yeah. Yeah, again, there's lots of options. I mean, when you're making decisions in any type of business, it's not always just cut and dry A to B. There's lots of different options. And again, you want to consider, when you can quantify the options and look at the total impact, then you get, in the long run, you make better decisions. What I did is I hired 2 more people, okay? And I also reduced the scrap and the inspection time, and I ended up with, 12%. So, for example, I probably could have just gone to 1 person and 16, and I still could have been at the, 7%. And still making more money. So anyway. All right, last one. So let me, hold on. All right, so this one is obviously going to be more complicated than the others. So if you go down to and this is sort of multi-level. So if you go down to the value stream income statement, you see the current return on sales is a little less than 9%. Management wants to improve that return on sales to 20% by selling more and trying to find ways to reduce costs. So, we know that 500, let's just make the assumption, we know that 500 more units per month can be sold. So enter that in rows 11 and 13 of the opportunity column. And then you'll see how that, take a look at the value stream income statement and see where you are in terms of return on sales. And no, you're not going to be at 20%. So now you have to think about what can be done improvement-wise to have some true cost reduction. So let me just give you some hints. If you do decrease the scrap rate, that's going to decrease the material cost by the way the spreadsheet works. If you decrease downtime, you can make the assumption that whatever percentage you reduce the downtime. So if you reduce the downtime by 50%, the repair and maintenance cost, you can reduce by 50%. You have to manually enter that in the future state column. And if you change the number of people and or overtime hours in rows 3 and 5, that will automatically change labor cost. So go ahead and give it a shot.
Should you put $35 in cell 59?
Yeah, that's right. Yeah, you're still selling them at $35. If that's not in there, that's a defect in the spreadsheet. I need to make a note on that.
I don't know why on the downtime, I have row number 35 and E on the future value. Is there any formula that has to be updated or something?
What, please explain that again.
On the future state column,
Yeah,
row 35, I have an E. I don't have a formula there. I don't know
oh,
if I can mess up with the spreadsheet or something.
row 35.
No, yes, 35, total time per month.
Oh, oh, wait, hold on one second. Okay, so the total time per month, that is row 35. That comes from row 9. So you have to change something up in rows 3 through 8 to change row 9, and then that'll change the downtime.
Got it. Okay, already updated. Thank you.
Okay. We're coming up at the bottom of the hour, if you guys can stay for a few minutes, please do, and then we'll just wrap this up because this is the last exercise. If you can't, I understand, and we can catch up later today one-on-one if you want. Just let me know when you're finished, and then we'll talk about it. Anybody want to share? What they did?
So what I did was I changed, I reduced headcount, took out the overtime, reduced scrap, reduced downtime, and then changed the 5S meeting in the huddle to be 10 minutes. And that brought me to a 20.21.
Good. Anybody else?
I kind of struggled on this one.
Oh, I almost got it there. I'm working with the return on sales. I'm also almost on a 19%. What I did was I changed overtime to, instead of an hour, to 45 minutes.
Okay,
I changed the scrap and rework to the 10%, the inspection time to a 25%, and the downtime to an 18%.
okay,
So the capacity end with a 12%, but the return on sales, I have to work on it because I still have it on the 19%.
okay, good. Yeah, I mean, you know, here, this is, again, 19% is good, okay?
Okay, thank you.
Yeah, we're just trying to get close here. We're not, so, yeah, I mean, what I did is I reduced scrap, reduced downtime, because I knew that those would have impact on the costs. I also, you know, because I reduced downtime, I reduced the repairs and maintenance by 50% also. And that got me to, and the labor costs went down a bit, so that got me to 20%. So again, it's you know, there's a lot of variables, and there's a lot of ways, you know, like, you know, there's a lot of ways to go about this. It really sort of depends, you know, these are made up exercises, and the point is consider all the variables, all the data, and what are the realistic options. You know, a lot of decision making needs to be made cross-functional, not just by one function, because you got to you got to consider the revenue side, the cost side, and like I said earlier, you know, in lean accounting can provide a leadership role in sort of coaching the organization through this new thinking process and the new numbers. So anyway, we're at the end of the session. Anybody have any questions about anything right now? What we did, was today's session interesting?
Yeah, this was good.
Yes.
Good. All right, so that wraps up the course. I don't have any dramatic wrap up. I had a lot of fun doing this. I always have a lot of fun. You were very good, all of you, in terms of participating. That's really what makes it, is the discussion and the interaction. And so I hope you join us for future events. You're on the mailing list, so you'll get all that stuff. And like I said, you know, you all still have a 1 hour free session, which you can use anytime. You have any more questions, please contact me. I will be sending out your certification certificates. Okay, you'll get that in email, maybe later today, if not tomorrow. Does anybody need a continuing education certificate? Okay, all right, so I guess
Yes,
we'll go.
David here, yes, I will be, I hope to have one. If you can let me send one or prepare one,
All right, yes, I will send it to you.
thank you.
That's also part of the course. Any final thoughts?
So, thank you so much.
You're welcome.
Yep,
If
thank you.
If you have any suggestions for improving, just send them to me, because I'm looking for ways to make this better. And the only way I know is by listening to the customers. So have a good day. Stay in touch and hope to see you at future events.
Thank you.
All right,
Thank you.
Take care,
Bye.
guys.
bye.
Okay, bye-bye.